Hello, and welcome to Foord's Mind of the Manager webinar. I'm Brian Arcese, one of Foord Singapore multi-counselor portfolio managers on the conservative Foord International Fund and the more aggressive and longer time horizon Foord Global Equity Fund. With the US, European, and Japanese share markets hitting all-time highs concurrently with safe haven assets, gold bullion, and now Bitcoin, with Hong Kong's Hang Seng index at 25-year lows, with Japan, Germany, and the UK in recession, and with central banks defying calls for rate cuts, it's little wonder why many are asking, what on earth is going on? I'll try to offer you my views of these seemingly contradictory outcomes during today's webinar. But to me, the bigger question is, how do we construct portfolios that manage the risks of loss from toppish markets while safely capturing opportunities for long-term returns? But first, I'd like to unpack the underperformance, for different reasons, of our two flagship funds over the past year, after we had delivered stellar return outcomes in these strategies in the big drawdown year of 2022, when global interest rates were first rising. In doing so, I'll speak to the main issues informing our investment thesis over 2023 and the resultant impact on investment performance. I'll then revisit our economic base case assumptions and highlight what, if anything, has changed since we last spoke in mid-2023. What risks do we see on the horizon that could impact our forecasts? What is the probability of each of those risks coming to fruition? And ultimately, what would be the magnitude of the impact on asset classes, markets, and most importantly, our portfolios? Finally, I'll speak through how we've taken our base case forecasts into account when constructing our portfolios. I'll talk to our current asset allocation as well as to how we're positioned both regionally as well as by economic sector. These should address the what on earth is going on and how on earth do we manage the risks questions. I'll leave it to my colleague JC Shui, a fellow multi-counselor portfolio manager, to speak much more in depth about an area of the market that is generating a significant number of questions, China. We'll then address questions received from the audience in a Q&A session after the formal presentation. Let me start with the performance review of our 26-year-old flagship product, the Foord International Fund, in which I know many of you will have long-term investments. The Foord International Fund is a conservative absolute return product. Given the choice between chasing investment returns and protecting capital, we're always going to choose to protect capital in this product. We did this well when the dot-com bubble burst at the turn of the century, well enough over the global financial crisis, and again well during the heavy COVID drawdowns of 2020, and certainly in 2022 when global share and bond markets plunged. Limiting losses when risks are high is a hallmark of this fund. But in worrying about the risk of loss in this fund, we missed out on the short-lived stimulus rally of 2021, as well as the AI-sparked rally of 2023, which has driven Western markets to all-time highs. Protecting the fund against market drawdowns also comes at a cost, especially if markets surge higher, as was the case last year. As a result, while last year was not the worst absolute return year of the fund's 26-year history, it was likely the worst on a relative basis. The fund was down 4% in US dollars when tech-heavy global share markets rose an eye-popping 24%. This year, the fund is down another 4% when markets are up 5%. This is hard to endure for investors, as well as for us as fund managers. And to be clear, as fund managers, we're also investors in this fund. There are three primary reasons for poor returns in 2023. First, the fund's conservatism impacted returns negatively. A combination of the opportunity cost of holding a smaller portion of the fund's assets in equities, as well as the direct cost of hedging the fund's equity exposure. If we had not hedged the risks building in US equities, fund performance would have been 3.8% better. So why did we put these hedges in place? Rewinding to mid-2023, we were confronted with inflation hovering near 7%, wage increases nearly 5%, and jobs market data, whether payrolls or job openings, that was exceeding even the highest of expectations. Against this backdrop of seemingly economic strength, equity markets had already begun pricing material interest rate cuts and were trading at ever more expensive valuations. It had been our expectation that peak US corporate margins Mid-single-digit or higher inflation and rising interest rates would both crimp corporate investment and weigh on earnings. While earnings growth did slow materially, especially after inflation, and earnings were virtually flat year on year, the correction was less than we would have expected, and as a result, the expected impact on the shares of US corporates has not come to fruition, or perhaps not yet. Second, the fund's investment in Asian and especially Chinese equities generated a negative return for the year. Although accounting for less than 10% of fund assets, the negative investor sentiment pressuring all Chinese shares cost the fund 3% for the year, since Chinese bourses fell by double-digit returns compared to the double-digit gains achieved by US share markets. As you know, Foord is an earnings-driven investment firm with a steadfast belief that if we properly forecast earnings, in particular cash earnings, share prices will follow. It is important to highlight that the earnings for nearly all our Chinese holdings grew during 2023, with many of our investments growing earnings at robust rates. For example, JD.com increased earnings 15% over the prior year, while the earnings of AIA, a leading Asian insurer, nearly doubled. It's not simply a result of a COVID rebound over depressed earnings. JD.com's earnings, for example, are 3 times the level earned in 2019. Yet the share prices were still negative for the year. Finally, the fund's relatively modest investment in the Magnificent Seven grouping of mega-sized US tech companies, which seven-handedly accounted for more than 40% of global market returns last year, weighed heavily on performance relative to global markets. Many shares outside the Magnificent Seven performed poorly last year, with low single-digit returns and many negative. As much as sticking to our valuation discipline has been painful through our lower weight to expensive, large-cap US technology firms, similarly, our keen focus on earnings and valuations has caused even more pain through our investments in Chinese equities. This is something of which we are acutely aware. We know that share prices can become disconnected from earnings, at times shockingly so. This not only creates angst and uncertainty, but it is also what creates opportunity. Clearly, when robust earnings growth is accompanied by declining share prices, something other than earnings is driving returns. Given the interest from investors and the importance of these Chinese equities in driving our global equity portfolio returns, as I mentioned following my remarks, JC will go into significant depth regarding the current overhangs impacting investor sentiment on Chinese equities and our thoughts on each. Turning now to our global equity fund, 2023 was also a challenging year. The fund returned 7.6%, which, though positive, was well below our targeted benchmark, the MSCI All Country World, which returned more than 22%. Here again, underperformance has 3 primary reasons. First, while fund investments in the information technology sector, including global software leader Microsoft, website platform company Wix, both generated good returns, the fund's underweight to this best-performing sector detracted overall. Though most investors are aware, it is worth highlighting the extreme concentration currently evident in US markets. The US Magnificent Seven, along with the balance of information technology, comprises 40% of the US S&P. Collectively, this group returned on average 80% in 2023, nearly 7 times that of the 12% return achieved on average by the 493 companies that are not included in the Magnificent Seven. While sticking to our philosophical valuation discipline can be painful in the short run, as evidenced by our cautious approach to the Magnificent Seven, often over our 40-year history, we've been reminded that security prices do follow earnings, and paying a reasonable but not excessive valuation for those earnings is of utmost importance in generating a sound, risk-adjusted, long-term return. Separate from our underweight to the Magnificent Seven, there were 2 additional primary detractors from returns. The first is the fund's allocation to cash, held to take advantage of the expected volatility in markets, in particular as valuations are expanding more quickly than earnings are growing. And second, as I mentioned earlier, fund holdings in China weighed heavily on performance. As mentioned, we're acutely aware of and share our investors' worry at the difficult returns period we're presently working through, particularly when comparing our returns to an exceedingly and increasingly US-heavy MSCI All Country World benchmark. As a reminder, we construct our portfolios with a long-term horizon often positioned far off traditional equity benchmarks. We have strong conviction both in our philosophical view that earnings and fundamentals drive share prices, as well as in our current portfolio holdings and positioning. Though admittedly patience is required, we are confident that investors who exhibit that patience will be rewarded. As has been the case in recent quarters, the interplay between inflation and interest rates will continue to be key determinants of returns for the foreseeable future, notwithstanding corporate earnings over the medium to long term. Beginning on the top right hand of this graphic, you can see that our expectations around inflation are largely unchanged. Driven by a respite and shelter inflation, we do expect core inflation to return to the high end of targeted levels by the end of this year. Shelter, which includes both rents and implied rents, comprises a third of U.S. core inflation and is currently running at 6% year on year. Excluding this component from core, calculations result in core inflation running at only 1.8%. Merely cutting shelter inflation in half would return core inflation, all else obviously being held equal, to that targeted level. As year-on-year rental rate growth has moderated to approximately 3% for the top 20 U.S. markets, we do expect that deceleration in shelter inflation to continue. It seems difficult to believe that only 5 months ago, markets held the view that interest rates would have begun their decline in 2023. We've long held the view that rates would remain higher for longer than investors had expected, and the market exuberance, in part, is what fueled our caution last year. While 2 months does not make a trend, we have now seen 2 months of U.S. inflationary data, including last week's CPI and PPI, that have surpassed expectations. While bond markets have been reducing their expectations regarding the timing and magnitude of interest rate cuts, equity investors continue to price the U.S. S&P at 19 times current year earnings. And that 19 times excludes the expensive IT and communication services sectors. This cannot be viewed as anything but expensive. Investors began 2023 with expectations of an interest rate reduced recession, which, if not fully priced into markets, was certainly top of mind. As this expected recession not only didn't materialize, but it was also met with accelerating growth, investors quickly shifted the narrative to fit the markets. First from hard landing to soft landing, and subsequently from soft landing to no landing, which at current valuations is what we believe U.S. markets are pricing in. This complacency is misplaced. As I mentioned last fall, on average, it has taken nearly 2 years from first Fed rate hike to the onset of an economic contraction, and this is looking at data going back 70 years. Today, we sit at the 22-month mark. I would also highlight that not only does GDP growth remain robust during these periods, but oftentimes it accelerates, which is, again, what we've seen during this rate hike cycle. Now, there's no magic to these numbers. Rather, the takeaway should be that simply because the economy has not yet contracted is no reason to argue that a contraction won't occur. And more importantly, the lag between the time of the Fed's first rate hike and a U.S. contraction that we're experiencing currently is well within the norm. For context, it actually took 18 months post-rate peak for the U.S. economy to tilt into recession leading into the global financial crisis. And in fact, we have seen rate increases materialize into recessions in both the UK and in Germany to date. While no two cycles are identical, we typically see earnings at the index level decline between 10 and 12% during a recessionary period, with obvious and significant variation across sectors and firms, and a coincidental contraction in valuation. So what typically results is an index decline of roughly 30% on average. Again, this is not prescriptive, though given our cautious view, coupled with elevated valuations, results in our belief that with patience, we will soon be able to purchase equities at lower prices and lower valuations. Now, before chatting through our international fund asset allocation, I wanted to remind investors of the fund's objectives. First, to protect capital. We guard steadfastly against the permanent loss of capital. While we endeavor to generate a positive return each year, importantly, guarding against permanent capital loss is not the same as guarding against all negative returns or against volatility. The fund's second objective is to generate returns meaningfully ahead of inflation through a full investment cycle, which over the fund's long-term history is what we have been able to deliver. Now, given our macro outlook, our current market valuations, and the fund objectives, it will likely come as no surprise that we are conservatively positioned. Our gross share exposure has been hedged using a combination of short index futures and index put options, with a 71% gross exposure to equities hedged through both short futures and put options down to 54%. Now, if that was too technical for you, the takeaway is that just over half of the fund is invested in shares, a very moderate amount, and mostly in shares in markets that are not valued at extreme levels. The fund's second largest allocation is to fixed income at nearly 20%, a combination of high-quality, short-duration sovereign and corporate credit. Now, as a reminder, this is a market increase from the near-zero credit held at the beginning of the rate hike cycle, and actually a doubling from the fund's credit exposure as of the end of the third quarter of last year. The fund's unconstrained mandate, which really allowed the managers to be absent credit during a period of rapidly rising rates, with bond prices moving inversely to rates, protected a significant amount of capital in 2022. Today, however, interest rates have risen to a level attractive enough to justify a meaningful and growing allocation. This is a high-yielding segment of the portfolio with very low risk of loss from these levels. At nearly 7%, the fund's gold position provides a proper hedge against both volatility and geopolitical risk. Now, importantly, we don't view gold as a sound hedge against inflation. The non-interest-bearing metal faces headwinds as real rates rise, and cash provides an attractive alternative investment. Since the peak in nominal rates seen last July, however, gold has returned 9% versus the 12% return in global developed market equities, and the metal has recently hit its all-time high. Well, only 2 quarters ago, the fund's second largest allocation would have been to cash. As mentioned, after nearly 2 decades, this mantle has now been reclaimed by fixed income instruments. Today, cash, both cash held on deposit in money market funds as well as synthetic cash created as a result of implementing our short futures positions, is 15% of the fund. Though liquid, quality fixed income securities do offer attractive returns, we also believe strongly that cash is an asset class that can and should be prudently used in our portfolio construction. Our ability to hold a meaningful portion of the fund in cash in 2022, a year in which both equities and credit declined, protected significant investor capital. Finally, the fund holds a 4% position in listed property. Now, property is an exceedingly local investment, and our position is held in Wharf Holdings, a leading developer and operator of A-class retail and office space in Hong Kong. Hong Kong property valuations are the most attractive they've been in nearly 2 decades, with shares of the firm trading at a substantial discount to book value. The firm has no debt, is and will be a key beneficiary as tourists, in particular Chinese tourists, return to Hong Kong, and we see material upside from these levels. The fund remains well diversified across sectors, and this is both the international fund and our global equity fund. Despite being not forced by mandate, the funds do hold equity positions in nearly every economic sector, though not at traditional benchmark weights. The funds are diversified across several economic factors. The largest sector exposures are in materials and energy sectors, and I'll take just a couple of minutes to walk through each of these. We often receive questions regarding our materials exposure, in particular in an attempt to reconcile our sizable weight in what is viewed as a cyclical sector with our cautious macro view and overall conservative positioning. And this is a sensible question. The fund's materials exposure is diversified across industrial commodities companies, precious metals firms, agricultural commodities players, and energy firms. Additionally, many of the securities themselves are less cyclical than traditional materials firms. Within our industrial commodities bucket, for example, is a position in Air Products. Air Products is a leading industrial gases company, which, although certainly supplying industrial manufacturing companies, also supply gases to defensive industries, such as hospitals. Our investments within the energy complex are also far less cyclical than the overall industry. SBM Offshore, for example, is one of only 2 large contractors globally offering design, build, and maintenance services for FPSOs, floating, production, storage, and offloading vessels for deepwater offshore drilling. The firm's backlog and cash flow spans literally decades into the future, The firm pays an 8.5% dividend yield backed by strong cash flow, which increases with inflation. It fits perfectly within the international fund's mandate, and we are long-term holders in both funds. Our materials exposure is comprised of companies whose earnings and cash flows are not only less cyclical than a traditional materials peer, but also offer more certainty. In addition to providing attractive risk-adjusted total return, each also offers a proper hedge against higher inflation. Now, as highlighted earlier, while core inflation has continued to decline, investors must be vigilant against the less certain path of headline inflation, driven by more volatile food and energy prices. In a scenario where global inflation measures return to target in the near to medium term, the underlying fundamentals of each of our materials firms will drive returns, while in a scenario where headline inflation remains stubbornly high, or even accelerates, these holdings provide that much-needed protection to the portfolio. This benefit was seen clearly in 2022, where investments in the materials and energy sectors contributed meaningfully to the fund's positive total return in an environment where global equities and bonds declined. Both funds remain equally well diversified across regions. In fact, they're more regionally diversified than traditional global equity and multi-asset products. Of note are the fund's exposures to the Asia-Pacific region, and in particular to China. As mentioned, Chinese equities comprise about 10% of our international fund's exposure, and slightly more than double that for our global equity fund. In short, these Chinese equities, both collectively and individually, are offering exceptional value, with many trading at multi-decade lows without sacrificing growth. There is significant interest in this portion of our portfolio. I'll now turn it over to JC for an in-depth discussion of both the challenges and opportunities evident in this market.
Thanks, Brian. Hi, everyone. I'm JC Xue, one of the multi-counselor portfolio managers on the Foord Global Equity Fund. And today, I wanted to provide an update on the Chinese market given the challenges it's faced in recent years. Specifically, I will review some of the key risk factors related to the Chinese economy, how those risks can be mitigated, and how negative investor sentiments create opportunities for long-term investors. I'll start with the debt situations, as it is one of the most cited risk factors in the market. The chart shows total debt to GDP ratio of some of the world's top economies. China bears note how China's debt to GDP ratio is very high at 280%. And if you include the debt from local government financing vehicles, which are used to finance infrastructure or urban development projects, it gets to as high as 320%, which you can see on the left-hand side of the chart. As an absolute number, it definitely looks high, but a high debt to GDP ratio alone doesn't correlate to an absolute good growth or bad growth rate for the country. As we can see in the chart, that the US total debt to GDP ratio is actually at similar levels to China, and US economic growth has remained robust. And then on the far right of the chart is Japan, which sits even higher at 450% debt to GDP ratio. And one would think that would scare off investors, but it has been one of the hottest markets recently. What is key here is thus less the absolute level of debt to GDP, but more what economic growth you are actually achieving from the borrowing. The high debt to GDP ratio is more concerning if marginal debt is generating less and less GDP growth. And this is a legitimate concern as it relates to the Chinese economy because its debt to GDP ratio has been growing at a fast rate, which suggests that the incremental returns from its investments have been deteriorating. I will elaborate in later slides how this is an issue that the Chinese government is actively working to resolve. But the other risk factor to debunk here is that there is no imminent credit or sovereign default event in China because of the limited amount of external debt. Most of the debt that China has issued is in renminbi terms, owned by government and the banks, which are controlled by the government themselves. And for the most part, China is one big closed system, which means that the state is able to restructure its debt if any stress builds up in the system. For example, a local government infrastructure financing vehicle in Guizhou received a 20-year extension on its debt and will only need to pay interest, not the principal, for the next 10 years. And just a final point on that. Investors are calling for more aggressive Chinese government stimulus and suggesting that it is not forthcoming because the debt levels are too high. Note the orange bars on the chart, which shows central government debt as a percentage of GDP. We can see that Chinese central government debt is only 20% versus around 100+% for many of the other leading economies. The central government, therefore, has more fiscal capacity to stimulate if it wanted to. For example, they can put money into consumer pockets like the US did, or they can reflate the housing market if needed. But they are actively choosing not to do so because they know they need to take the short-term pain of restructuring the economy to resolve some of its inefficiencies. And this ties in directly with what I'm going to talk about next, which is the property development sector that has attracted a lot of external focus, and rightly so. We've all read about the Chinese property sector headwinds, but how many of us have realized that it is actually self-inflicted? So if we look back, at the end of 2020, the Chinese government put in place 3 red lines restrictions, restricting different leverage and liquidity ratios at property developers to curb speculative behavior in the sector. Why did they do that? Because houses are for living in, not for speculation. Right? Every investment that the government makes has a financial and social return on investment, which is highlighted on the X and Y axis of this chart. For example, if you look at high-speed rail investment, the China Railway prices tickets low, which generates low financial return on investment, but it creates very high social return on investment by reducing the friction of traveling between different cities. Real estate, on the other hand, has seen lower return on investment on both the financial and social axis as a result of speculative behavior. The optimal investment should really sit as close to the efficiency frontier curve as possible, as represented by the dotted line. With real estate contributing more than 20% of Chinese GDP, the government needed to shift investments away from lower return on investment real estate sector towards higher return on investor sectors such as electric vehicles, batteries, and the various other technology infrastructures. And this is why they are not propping up the real estate sector, and instead they are allowing the sector to restructure itself. But as property developers get into trouble, is the Chinese government not worried about triggering a property crisis like that of the US during 2008? Right, the chart shows the minimum down payment ratio for a house across different countries. In China, before the recent adjustment, a down payment in Beijing and Shanghai would be around 35% of the purchase price compared to 5% in the US or 10% in UK and Japan. And a second home in China requires 50% upfront, and any additional houses after the second home needs to be paid for in full. As such, for the most part, real estate investments in China are made in cash and not via loans, which creates an entirely different situation when it comes to the impact of a property market downturn. Simply put, the leverage conditions that caused the US housing crash of 2008 simply doesn't exist in China. There is no widespread use of subprime mortgages or securitization that could cause systemic risk. In fact, Chengdu's Southwestern University estimated that even if home prices plunged by 30% in China, only 3% of households would become financially insolvent. So yes, lower house prices does hurt consumer confidence, but the economy is going to be in a much healthier place when China eventually emerges from this recalibration of economic growth drivers. So where are we today? This chart shows the rolling 12 months property sales value across China. Since the peak in early 2021, which is indexed to 100, property sales have already declined by 35%, and the most aggressive private property developers have already defaulted or are undergoing restructuring or bankruptcy. And along the way, the government has rolled out multiple rounds of easing measures which included financial assistance on the developers' end or rate cuts, and down payment reduction on the consumer demand side. We think that the recalibration of market is likely to bottom up sometime this year, with sales values probably declining a further, call it 5 to 10%, and the supply and demand is going to find a base and balance before organic demand becomes the driver of growth again thereafter. And remembering that urbanization is still continuing throughout China. In the meantime, the government is going to continue rolling out targeted easing measures, and most recently we saw rate cuts where the Chinese central bank reduced prime lending rate by 0.25%. We will also see further loan extension from banks, and then on the demand side, urban village renovation will add about 5% new home demand in the interim as occupants are moved out of these villages. We will see continued adjustments to the down payment rules to manage demand, and the government has also started whitelisting projects for banks to support, ensuring financially sound projects get the required financing to enable project completion. This ensures that projects are going to be delivered to buyers without delay, preventing any further crisis of confidence. And all of these measures are preferable to the easy stimulus route, which might again reflate the property bubble. Right? The focus is going to be on the balancing the support and allowing for an orderly restructuring of the real estate sector. One of the very real consequences of falling home prices is the wealth effect and the impact to consumer confidence. So the third risk to address is exactly this, the low consumer confidence that's hurting consumption across multiple end segments. And we can see on this chart that the Chinese consumer sentiment now sits at 90, which is a 20-year low. So the question is, how will sentiment move from here going forward? Now let's visit the fundamentals underpinning consumer confidence. Sure, there's the wealth effect which has impacted confidence, but the national saving rate coming out of COVID is actually at 33%, up from 27% a decade ago. Western economies can only dream of this level of savings. And to put it simply, the Chinese consumers have money to spend. If we look at unemployment rate, that's at 5%, down from 6+% during the pandemic, and it's similar to the unemployment levels before COVID interruptions. Sure, I think the youth unemployment is high, but it has really been exacerbated by a temporary mismatch created by COVID impacting the economy. Some high-profile regulatory clampdowns, for example, has hurt private enterprises, which previously employed a lot of young graduates. As we lap some of these headwinds going forward, we should see an improving trend in youth employment going forward. And then, just to touch on disposable income as well, that has been growing 6%. If we look at retail sales, it's growing at 7% in 2023, and overall tourism revenue over the most recently concluded Chinese New Year travel period is already 8% above the 2019 levels. So things are really not that bad, and the foundations exist for the Chinese consumer to rebound over the next several years. The fourth risk to touch on is regulation. In December, gaming regulators released draft gaming regulations that triggered new fears about the level of government intervention in the more successful areas of economy. Specifically, one that spooked the market was a new rule proposing to limit how much money players can add to their in-game wallets. There was some ambiguity about what the limit would be, which had clear implications on how much money gaming companies can make from their games. And this draft really caught the market off guard and triggered a big sell-off in stocks like Tencent. But the government quickly U-turned, and by January, the head of the publishing unit at gaming regulator was fired as punishment, and the regulators also came out to clarify that the draft is still due for consult with industry participants, with details to be ironed out to soften their tone. And more recently, many gaming companies are reporting that the draft would not be implemented without significant and favorable amendments. It is therefore clear that the Chinese government recognizes the importance of the market. They know that the confident market is so important to drive foreign investments, and comments coming out since have remained supportive for private enterprises. The last risk to highlight is the undeniable fact of China's aging population, which is a structural headwind to its economy. But there are multiple levers that China can use to offset the impact. If you look at the chart on the left, it shows urbanization trend across China, Korea, and Japan. And for Japan and Korea, after reaching where China is at a 64% urbanization rate, they gradually saw urbanization rate step up towards 80% over the next 20 years. So from the current levels, China has more than a decade of urbanization left, after which it should hit an urbanization rate of 75%, which suggests another 150 million or so people will move from rural into urban cities. This will supplement the labor situation as cities facilitate better matching of jobs and skills, drive more specialization of labor, and result in stronger consumption from migrant workers. Now, the chart on the right shows agriculture share of total employment in China is still at 20+%, and that's despite declining from more than 50% over the last 20 years. Developed markets like the US have agriculture employment rates at 2%, and the US was at 25% back in the 1930s. By 1970s, it hit 5%. So from this, we know that increasing productivity in the agricultural sector is going to drive, again, labor share shift into other sectors through education, through retraining. And here's another lever that the government is pulling to maximize the use of its labor force. And finally, the retirement age in China is still low, with 60 for men and 50 to 55 for women, when most other countries are already at average of 65. So there is significant room to gradually step up retirement age, which increases the labor force. Beyond all this, government is also encouraging more childbirth through new policies, while also pushing for tech adoption to improve worker productivity. So in short, the aging population is challenging, but not one that can't be mitigated with a series of good policies. In summary, the Chinese debt situation is manageable, with the government committed to shifting investments from low return on investment real estate sector towards higher ROI sectors such as the electric vehicle sectors or the new energy sectors. The property markets and therefore consumer confidence is close to bottom, and consumer fundamentals are strong, while the regulatory environment is going to remain benign, and there are many levers to offset the aging population headwinds. Now, the last part of the presentation, I want to spend some time to just contextualize this risk in terms of the market cycle and share where we are in terms of valuation. Every market is going to come with its own set of risks, but what is important is that we assess the risk and calibrate earnings growth compared to market valuations. We've looked at the key risks, but where are we in terms of valuations now? So this chart shows the historical PE ratio of Hong Kong's Hang Seng index going all the way back to 1996. The price to earnings ratio is a measure of how expensive or cheap the market is, with a higher level representing expensive markets and lower level suggesting cheapness. The shaded areas are crisis periods. So at 9 times earnings, the current PE ratio is trading not far from valuation levels during the Asian financial crisis of 1997 and global financial crisis of 2008, and those were really severe crises. To provide some context for how bad things were during those times, let's just cast our mind back to 1997. And I'm sure a good number of viewers will be able to recall those days. The Indonesian economy, for one, ended up collapsing along with its currency. The market crashed, the rates went up to 99%, couldn't go higher because the IT systems didn't build in the capability to account for triple-digit interest rates. It was so bad that people were literally selling guns outside the Hilton Hotel in Jakarta. There was mass unemployment, riots across Indonesia, buildings were being set on fire, and the Hong Kong market went down 25% in 4 days in October of 1997. If you look across the region, the Thai property index was down 99% in USD terms. South Korea had to be rescued by the IMF, and things were really, really bad. And the Hang Seng index bottomed at an 8 times price to earnings ratio. If we just contrast that with China today, official GDP grew 5% in 2023. Unemployment is back to pre-COVID levels, retail sales growing 7%. There are challenges and risks, but the underlying fundamentals do not justify valuations close to Asian financial crisis levels that I've just described. I would also like to highlight just one quote from a book on the Asian financial crisis. Economists, analysts, fund managers, and journalists were unanimous in their attacks on Thailand, predicting depression, massive devaluation, surging non-performing loans, and political incompetence. Today, we are seeing a very similar unanimous bearish view on China, given that China is an uninvestable team. But if one were contrarian enough to invest in the Thai index, for example, during the Asian financial crisis and held it for 10 years, the US dollar compounded returns would be 18% a year. And similarly, if one invested in Hong Kong's Hang Seng index during that period, the returns would have been 11% compounded over 10 years. So with that as context, we get to how Foord is positioned. The chart on the left shows the average earnings growth of Foord's Chinese holdings in 2022 and 2023. And the chart on the right shows the price-to-earnings ratio, how the price-earning ratio have trended over the same period. And we can see that despite earnings growth accelerating into 2023, we have seen a de-rating across our portfolio of Chinese companies. As a group, they trade at 11 times PE ratio today, and if we exclude the cash and investment holdings at these businesses, the PE ratio is closer to 6 times, which means that just 6 years' earning will recoup the purchase price if we exclude cash and investment holdings. Now just compare that against more than 19 times for US markets and even more eye-popping valuations for some of the US tech companies. Now in terms of earnings growth, given the macro challenges, 2024 earnings growth is expected to be more moderated across our holdings, but we do expect 12% per year earnings growth over the next 3 years, and overall valuations continue to price in very little growth compared to our expectation of low double-digit per year earnings growth going forward. Valuations continue to remain attractive despite the manageable risk. And finally, just to conclude, we believe that the Chinese government will continue its gradual and targeted easing measures going forward with no appetite to reinflate the property market again. A lot of global investors have already exited the Chinese market over the last 3 years, and there simply has been far more foreign sellers than buyers of Chinese shares. Positioning is already extremely bearish, as evident by the continued derating of the overall market, which provides a good setup for returns to be driven by underlying earnings growth. And in our Chinese investment cases, we expect the average of low double-digit earnings growth, and any improvement of confidence resulting in re-rating will easily drive returns towards more than 15% a year. And lastly, it's important to note that we are not anchored to China. We continue to go where we see value, and today, the valuation versus risk-adjusted earnings growth continues to be attractive for many of our Chinese holdings. I hope that's provided a lot more color behind how we are thinking about risk and opportunities that we see in the Chinese market. And with that, we now move to Q&A. Thank you.
Thank you, JC. That was really insightful. We have received questions, both when you were speaking during our webinar today and previously shared with us as well. So we'll walk through some of those now. I mean, in particular in regards to China, we have gotten a number of questions around geopolitics. So maybe I'll ask you two, if I may, in that vein. The first one is about the US election that's upcoming at the end of this year. Obviously, President Trump, or previous President Trump, has just recently, again, clinched the Republican nomination. He was the original administration that was in office that enacted a number of the tariffs that, to be fair, are still in place. But maybe you can just walk us through your thinking around that US-China geopolitical rivalry, in particular, as we're moving towards another US presidential election at the end of the year.
Sure. I think the probability of Trump coming in is definitely real. So, we will go back and actually try to figure out how the markets actually did during the different presidential tenures. So if you look at what the Chinese market did when Trump was the president from 2017 to 2020, the China Internet Index actually went up about 20% a year for the 4 years that Trump was president. In comparison to S&P only went up 13% a year during that period. So that actually came as a surprise to us. And then if you look at the underlying corporate like companies, right, you will see that Tencent during the same period compounded 33% from a share price terms. And that was largely driven by underlying earnings. Right? Tencent's underlying earnings growth was 28-29% a year during that 4-year period as well. So what that tells us is even though people would view Trump as bad for China in terms of the headlines, in terms of the trade war rhetorics, but what actually happens with a 3 to 5 year view is that the underlying share price performance ultimately is still driven by earnings, right? As we just saw with the case of Tencent, right? And then if you fast forward after Trump, it was Biden, and in the last 3 years, the China stock market actually did quite poorly, and it was Biden, right? So one could argue that regardless of who the president ends up being in office, the US is not going to slow down the competitive intentions against China. The competitive dynamics, no one is going to back down necessarily. Trump might be louder than the next, but that's headline, right? Underlying fundamentals are not going to change that much. And then just maybe to touch on one last thing here is the fact that the China market has derated over the last 3 years, right? Valuations are very low. Compared to US, right, 19 times PE for the S&P index. If we have another trade war, right, the likelihood of Chinese companies outperforming American ones is actually quite high, because if you recall in 2018, the S&P index after Trump's trade war actually went down 20% by the time December came in 2018, right? So American companies are hurt as well. It's not going to be a one-way impact.
That's helpful. And I mean, if we look at the economic war, right, through tariffs and trade war and otherwise, but then the other question that we receive a lot is about the potential for that to escalate into a military conflict, in particular around Taiwan. So maybe you can give us your thoughts and expectations around the potential for China to invade Taiwan and attempt to reunificate militarily.
Right. I think we think about this, I guess, on the short and medium to long term, right? In the short run, the probability is really quite low. And a big part of that comes down to military capabilities, right? China simply do not have the technology and capabilities enough yet to attempt a successful takeover and invasion of Taiwan. And it's not just down to the aircraft carriers and having enough of a big enough naval force, right? Taiwan as a geography, is 150 kilometers away from China, right? We think about the Ukraine-Russia war, that's a land-based war, and how difficult it has been for Russia to successfully, take over Ukraine. It's just the difficulty is magnitude more difficult, right? To engage in an ocean-based warfare, and not forgetting the fact that Taiwan geography is very mountainous. There are very few landing locations on the Taiwan island itself, so those are easy to defend. So the difficulty is just very high, right? So in the near term, is really very low probability of it happening. But with a 3 to 5 year view, this risk is still real, right? And the way I think we can mitigate this and manage this risk is really to look back at what happened during the Ukraine-Russia war. And back then, weeks leading up to it, Western governments started asking their citizens to leave Ukraine because the Western intelligence organizations would be, looking at various matrix satellite images to inform them of the probability of a war actually happening. And they know way more information than any of us do. So anytime we see, let's say Western government starts warning citizens to get out of Taiwan, I think it's definitely a signal that we need to take very serious into account. Right? And then ultimately, if you recall, President Biden, days leading up into the actual invasion, actually explicitly said that Putin is going to invade, Ukraine. And you could have get out then, because market only fell 15%, right? You would have avoided the 60% drop when Russia actually invaded. So for us, it's about controlling the exposure. We have to make sure that outsizing to the Taiwan market and China exposure, as we get closer and closer to 3 year, 5 year, and as the probability of a war increase, we have to manage that risk very closely.
Yeah. It's really about, as we chat a lot about, we view ourselves as much as risk managers as we do portfolio managers. And in order to earn a return through time, you have to take risk. But here, it's a risk that is monitorable, right? And if the tensions escalate, for example, we can mitigate exposure quite quickly, and would certainly do that, obviously. Yeah. We do have a question around when do you expect the Fed to start cutting rates? Are there risks to the current narrative as reflected to what's priced into markets currently? So maybe I'm happy to take this one. I can give you a bit of a break and just chat about our expectations for rate cuts as we move through the year. We aren't really in the business of forecasting a specific month when the Fed may start cutting rates, but we can give a bit of framework as to how we think about it. So there are really two primary reasons for the Fed to think about cutting rates. The first is if inflation obviously returns to target, right, which isn't where we sit today. I mean, if we look at January and February, which really 2 months clearly don't make a trend, but if we look at inflation in January and February, it did come in higher than expectations, both CPI and PPI in the US. If you extrapolate the month-over-month growth for those 2 months through the end of the year, you end up at an inflation number year-on-year that's closer to 4%, so clearly not in trend. As I chatted about during my presentation, it is our expectation that inflation will come down closer to trend, if not within target by the end of the year, but we're certainly not there yet, so we wouldn't expect the Fed to be cutting today. The second reason that one would expect a Fed cut is because of slower economic growth. Obviously, in particular in the US, we are seeing quite a strong labor market. We're still seeing growth in retail sales, and while we're seeing the economy slow, we certainly aren't seeing a sluggish economy. And so really, for both reasons, inflation continuing to trend above target and economic growth coming in kind of better than expected, or certainly still strong, we don't expect the Fed to cut today, and perhaps not even in the first half of the year. Relative to market expectations, I think the market has moved closer to where we are now. We've always been of the view that rates would stay higher for longer. If we rewind to the end of last year, markets were pricing in 6 rate cuts by the end of 2024, so at least 150 basis points of rate cuts, which to us seemed quite aggressive. The market today is pricing in 3, so 75 basis points starting sometime around mid-year. If anything, we still think that's probably on the margin aggressive, but clearly far less aggressive than the 150 basis points that were priced in. So our base case is for the Fed to begin to cut rates when they have a bit more color on the direction of inflation, that it is at least again trending far closer to target, and or if we see the economy starts to slow, both of which we expect to happen in the second half of the year, sort of not in the first half of the year, which is where we sit today. And then maybe one last question that actually also takes us back to China, but in particular comparing China to Japan. So we get that question a lot as well, and I've received it again today, both from a demographic standpoint, right, and also both large markets that have gone through kind of property overhangs. I mean, obviously comparing it to Japan, which is a market that hasn't grown in real terms for a number of decades, and the stock market itself only returning to highs relatively recently, the highs reached sort of pre-economic slowdown. So maybe you can chat us through your own thoughts around comparing China to Japan.
Sure. I think it is rational for investors to make that comparison, just given, you mentioned, right, aging population, you have property slowdown, but when we dive down into the weeds, we realize that that's pretty much where the similarity ends between the two economies. If we revisit Japan in the 1990s, they were already one of the richest countries in the world, right? Urbanization was close to 90%, per capita GDP was one of the highest in the world. They had a number of multinational businesses that were already leaders, not just in Japan, but on a global basis. Now, coming back to China, right? China today is seeing property slowdown, but urbanization rate, as I mentioned in my presentation, still sits at 60+%, a long runway to grow there. They're still a developing country. And one of the biggest difference, I think, is the fact that when Japan's bubble burst, it was a result of strong economic growth driven by leading enterprises, the likes of Toyota, the likes of Toshiba and Sony, right? All these businesses spent the 1980s growing outside of Japan and driving the strong economic growth in Japan. And by the time the bubble burst in Japan, there was no one else to replace that growth. There wasn't anyone sitting in the back to take over some of the growth drivers from these leading enterprises. This is a big contrast to China because, as I mentioned earlier during the presentation, is that the property slowdown was self-inflicted. They make an active decision to say, I want to restructure the property sector. So on the bench, they have many sectors that are ready to take over the baton of growth for the economy. You have the automotive, electric vehicles, right? You have the likes of BYD, to our mind, is going to is embarking on the first initial years of internalization, right? They are going to become the Toyota of the future. You have the solar industry. 80% of the entire solar supply chain sits in China, right? You have 60% of wind turbine being produced in China. All of these are new energy sectors that is going to help take over the baton of growth from some of these older industries. And all these are industries that are a lot more productive than the labor-intensive ones that are increasingly moving out of China into the Vietnams of the world, right? So, these are just some of the key differences. There are a lot more differences, but, these are what give us comfort that China is simply not going to be the next Japan from a pessimistic standpoint.
And I think what struck me in your answer there is particularly one of the things you said at the beginning of it was that it is a very sensible question, at least on the surface, to wonder about the comparison, right, the similarities between China and Japan. And I think that that's actually quite true for each of the kind of questions/headwinds that have impacted the China market that you walked through during your presentation, that all of these questions are very sensible questions to ask, but the answers, well, some are actually quite simple when you do the bottoms-up fundamental work. They're not all simple, but they all require bottoms-up fundamental work to arrive at an appropriate answer. And it's really in that work where we find the opportunity, right? The large disconnect between what's priced into the market today, and obviously even more so in the equities that we own, or more importantly, in the equities that we own in China, relative to our expectations kind of going forward. It's always difficult to sort of time sentiment change, I think. But ultimately, we're obviously focused on the bottom-up fundamentals and do have an expectation that many of these will start to move in the direction where fundamentals will be rewarded as we move through sort of the balance of the year. At least that's what I kind of gleaned from listening to you myself as well. Yep. But thank you very much for the answers. I think that they were very helpful. Thank you, everyone, for attending as well. There are and were other questions that we weren't able to get to today. In particular, and we do appreciate those attending from many markets around the world. For those that had market or country-specific questions, we will get back to you individually. Please be a bit patient. And then secondly, please do take the time to respond to the survey that will pop up just as the webinar is ending. We do take the feedback to heart and use this to shape our future webinars. So thank you again.